Retirement marks a significant shift in financial priorities, moving from accumulation to preservation and income generation. For many retirees, fixed income investments, otherwise known as bonds, may play a vital role in creating a stable and sustainable retirement portfolio. So today we'll explore 4 key benefits of including fixed income in your investment portfolio, and we'll discuss a potentially significant risk to your fixed income allocation. So let's get right into it. Now, the first benefit of including fixed income is creating a diversified portfolio. What is portfolio diversification? Well, it involves spreading your investments across various asset classes, such as stocks and bonds, to reduce portfolio volatility or risk. By balancing growth-oriented equities with the stability of fixed income, you can achieve a more consistent return profile over time. So why should you diversify? Well, a diversified portfolio can help protect against market downturns. While stocks offer higher growth potential, bonds can provide stability and income, acting as a cushion during volatile market conditions. More often than not, bonds are uncorrelated or even negatively correlated with stocks. So when the stock market is down, investors move to assets they view as safer investments. And that's why we sometimes see bonds appreciate in those kind of market conditions. Now, this balance helps a retiree's savings last longer and potentially be less susceptible to sudden market shocks. But real quick, before we move on to the second benefit, I'm Sean Stevenson. I'm a CFP professional and wealth associate at Confluence Financial Partners, where I've had the opportunity to review and build dozens of financial plans and investment portfolios. I'm sharing all my knowledge with you. So if you're interested in seeing more videos on retirement planning and investing strategies, give me a follow. And if you're within 5 years of retirement, click the link in the description and get a copy of our Retirement Readiness Workbook, which is a simple, actionable guide that will walk you through what we believe are the essential steps to achieve a worry-free retirement. Now, let's move on to the second benefit. So the second benefit of including fixed income in your portfolio is reducing portfolio volatility. So what does volatility mean? Well, it refers to fluctuations in the value of your investments. Bonds are typically less volatile than stocks, making them a reliable component of a retirement portfolio. So why is it important for retirees specifically? Retirees depend on their investments for day-to-day expenses. Large market swings can jeopardize the sustainability of their withdrawals, and that's called sequence of returns risk. So by including bonds in your retirement portfolio, investors could potentially smooth out returns, providing greater peace of mind and consistency of income. Now, although I'm not a huge fan of rules of thumb, since they can oversimplify financial planning techniques and strategies, a good one I've heard before is to have 5 to 10 years worth of annual retirement spending in fixed income. So if you spend $100,000 per year in retirement, you'd invest about $500,000 in fixed income. And if your portfolio were about $2.5 million, that would equal an 80% equity and 20% fixed income allocation. Now, if that's too aggressive based on your risk tolerance for volatility, you could do 10 years worth of spending or $1 million in fixed income, which would be a 60% equity, 40% fixed income allocation. Now, again, this is just a rule of thumb and not necessarily a strategy that we'd recommend because every person's situation is different. So the third benefit of including fixed income in your portfolio is maximizing your income up to a certain level of risk. So investors can optimize their income by selecting bonds with expected income and return characteristics that align with their risk tolerance and income needs. For example, treasury bonds tend to offer lower yields since they are seen as a safer investment, since they're backed by the full faith and credit of the United States government. Whereas municipal bonds are debt issued by state and local governments, which can provide tax-advantaged income for investors in higher tax brackets. Then you have corporate bonds, which offer higher yields but come with slightly higher risk. And then you have high-yield bonds, otherwise known as junk bonds, which offer much higher returns but much greater risk. Now, the fourth benefit of fixed income is consistent income. By holding a mix of different types of bonds, retirees can create a reliable income stream, since holding non-correlated securities often reduces portfolio volatility, like we discussed. For instance, in your portfolio, you may hold treasury bonds to provide safety while also holding corporate and municipal bonds to add yield. This approach offers income stability even during fluctuating interest rate environments, which can be the most impactful on your fixed income allocation, which is a little prelude to our next section on risk. You can also look at creating a bond ladder by staggering bond maturities, which can create a steadier stream of income while mitigating interest rate risk. By tailoring a bond strategy to your individual goals, retirees can strike a balance between income generation and risk management. As we discussed, utilizing bonds to diversify your portfolio is important, since it can often reduce volatility, increase portfolio income, and make your income more stable. So what is a significant risk to investors that invest in fixed income? Well, that is inflation, which erodes the purchasing power of fixed income payments, especially if we're experiencing higher inflation than the yield on our fixed income allocation is generating. since a 3% annual inflation rate can significantly diminish the value of bond interest over a 20-year retirement. So how can we address inflation risk? The first is you can look at TIPS, or Treasury Inflation Protected Securities, which are bonds specifically designed to adjust with inflation. You also look at shorter duration bonds or bond funds, which are less sensitive to rising interest rates, which usually accompany inflation. You can also diversify across other asset classes. So combining fixed income with equities and real assets can hedge against inflation's impact, such as we discussed earlier in this video. So in conclusion, fixed income investments are a cornerstone of retirement planning, offering stability, income, and risk management. By diversifying across stocks and bonds, reducing portfolio volatility, maximizing income within a risk framework, and addressing inflation risks, retirees can build a robust retirement portfolio. With careful planning and the right mix of bonds, you can enjoy more secure and consistent retirement income. If you haven't received a second opinion on your investment portfolio in some time, feel free to schedule a retirement consultation call with me in the link in the description, and we can discuss your portfolio and your plan. I hope you enjoyed today's video, and as always, great days ahead.